Knowing how to pick stocks is one of the best superpowers that there is as an investor in the stock market. Investing in the ETFs like SP 500 and QQQ that track these indexes is great, and you'll get 8 to 9% back annually on average for the rest of your life. But being able to pick a stock and get 5, 10, 100 times your initial investment is a superpower. This live stream series is going to be all about teaching and showing and running you through how I look into a company from the spark, what gets me interested at first, what gets the stock on my radar, and then what I do from there to dive more into the fundamentals and to understand the business, and ultimately on whether or not I want to be an investor. Because at the end of the day, we are investors, shareholders in these companies. It's not make believe. We are shareholders, we are investors in these companies. So I wanted to start out by just going through some of the stocks that I've already been calling out, already been talking about, kind of running you through briefly some of those. I've already done deep analysis, lots of videos, lots of posts on X. If you're interested in those, check out my YouTube channel. I have several videos on Oscar, D Local, and a bunch of other stocks. So definitely give that a look and watch. Wanted to say what's up to everybody. I appreciate you being here today on a Saturday, and I think it's super awesome. You're taking some time on your weekend to come and learn and try to better yourself on the investing side of things, right? This is all stuff that I teach in our community as well. So if you ever wanted to join that, it's the High Five community. It's linked on my X and my YouTube if interested as well. But let's get into it, guys. So, I first wanted to talk about Oscar. We're going to keep it brief. Okay. I talk about Oscar a lot. Love the company, love the mission. But at the same time, there's so many other companies out there. There's so many other missions out there. You can only talk about a company so much for so long. Right. And then eventually it's just, okay, we just have to wait and let the thesis play out now. Keep monitoring it, stay up to date with earnings calls, so on and so forth. So we'll go over Oscar a little bit real quick. Let's see. So we have Seeking Alpha up here. This is how I normally get data and look into companies. Obviously, you guys know I also look on my High Five snapshot. I plug in the data here, and I'm really looking to see a snapshot, a quick, brief little snapshot of what the company is, what their fundamentals look like based on earnings per share, based on revenue growth, this kind of cash flow model, based on all of these factors. And to first and foremost, before I go into all the research, all the due diligence that takes lots of time, lots of effort, I first want to make sure that it's even worth my time. If I punch in the analyst numbers and it's telling me this is extremely overvalued and it's on every metric, PE, free cash flow yield, free discounted cash flow, PEG ratio, earnings per share, like it's just not a buy whatsoever. Why would I then go and continue to do all this work and put in all this work to research this company? It just doesn't make sense to me. To where if I punch in like an Oscar or Zeta or some of these other companies, right, it's very easy to see that, okay, we have undervaluation here. But just because we have undervaluation doesn't mean it's a buy, doesn't mean that we go and run and buy it. We still have to understand the business. We have to understand where the fundamentals are coming from and how they're being, plotted and what's it looking like for the future. Because just because they have 12 billion revenue growth or 12 billion in revenue this year doesn't mean next year they'll have the same thing. So you have to look at an array of factors, right? So first and foremost, typically what I look to do with investing is I first look for a spark. That spark can be, I don't know, I'm at the grocery store and, I pick up, I'm looking for a new energy drink, which I don't drink energy drinks anymore. Just giving an example. And I see Celsius, they got really good branding and they're branded as like this more fit brand. And I pick up a Celsius, I drink it and I say, "Oh, it's actually pretty good. I'm going to, continue to buy this product." And then I sit there and I think, well, maybe they're a publicly traded company. And so then there's the spark. So then I look into that company and I say, okay, awesome. This is a smaller company. They make their competitor Monster and Red Bull, and they create energy drinks, but their branding is for more fit. And then I sit there and say, do I think this company can carve out a good little, you know, um, part in that total addressable market? And if I think yes, then from there I come on over to my high five snapshot, and then I'm going to go ahead and punch in the numbers. And then from there, if it tells me it's undervalued, if it's a buy, then I'm going to dive deeper into annual reports, quarterly reports, and overall business and understanding what the strengths, weaknesses, opportunities, and threats are. Also, what my bull thesis is, and then running a wide array of ultra bear, base, bull, and ultra bull cases, right? And just understanding where a stock is at and how much risk I'm taking investing in this company versus how much reward is there. With something like Oscar, I believe the risk is very, very minimal based on their net cash to net debt position, based on how much free cash flow they consistently pull in, and based on them being such a small market cap, right? So I believe that the lowest they can go without just starting to derail from the bull case or even base case would be about 10-11 bucks per share. They can always go lower, and stock price doesn't always follow the fundamentals, as we know. If it did, then Oscar would be more so 40, 30, 40, 50 bucks per share. But that's kind of like my mindset around investing. There's usually a spark. The spark can sometimes be something I saw on X that intrigues me, somebody that I respect their opinion, or I respect their due diligence or their mind, and that sparks me to look more into a company. And a lot of people get all caught up in like who was first to call out a company. Like the chances are that nobody was first, or you don't know the person that was first to invest in the company, or the person that was first to invest in the company probably isn't even an investor anymore in the company, right? You could have been buying Oscar at like I think $3 during the bear market. And maybe that person that initially caught on to Oscar and Mark Bertolini, the great CEO, maybe he already sold at a 7x, or even higher than that, a 10x, right? So it doesn't matter, right? If you get an idea from somebody or something like that, it doesn't matter. What really matters is that you do the research. You have that understanding of the company. That way you can hold through all of the fear, uncertainty, and doubt. And like something like Oscar right now, there's definitely there's a ton of fear, uncertainty, and doubt. A ton. There's constant analysts coming out and downgrading the stock right now. The healthcare market overall, and especially the health insurance market, due to political things, political bills, policies, changes, it's in the dumps. It's in the dumps. But I like buying things when they're in the dumps. I liked buying in April and May when the stock market was absolutely on fire. I got to buy Amazon and Meta and Google and all these great companies like Nvidia at like 99 bucks per share. To buy all these great companies at a severe discount while everybody else was screaming recession and everybody else was screaming that we're going lower. I was buying more. And now we are back at all-time highs. And when we're at all-time highs, guys, it is very difficult to find great deals. And sometimes those great deals can be what most call a value trap. Typically, what a value trap is and what it means is essentially that, yeah, the metrics say that it's undervalued, but there's core underlyings to the business that actually it's not undervalued. You're just You're just harping too much on the numbers, which it's hard to say what company is a value trap. It's hard to say what company is not a value trap. Okay. Um, PayPal is a perfect example of this. It's been one of those names that have been called a value trap for a very long time now. It's still sub $80 per share. It's been there for a while now. And even though the fundamentals scream that it's undervalued, it still hasn't gone, even close back to where it was at 300 plus per share. Right. So the fundamentals are there, the numbers are there, but the stock price isn't. And that can either be it's a broken stock, meaning people they don't have the confidence in it and to buy it and hold, or it is a value trap. So that could be the case for a lot of different stocks. So you do have to be careful when you are in companies that could be considered that. But the health insurance sector, it's not a value trap sector. And here's why. It's not a value trap sector, or it's not like these names aren't value traps for one distinct reason. The whole sector is under scrutiny. Not yeah, they're under scrutiny and they're under pressure because of policy changes, because of these things going on in the government affecting and tightening down the wrench on health insurance names, even healthcare names. This whole sector is very weak right now. It's not just Oscar. It's not just United Health. It's not just United Concordia. It's not just um, Elevance, right? It's not just one company having high medical loss ratios. It's not just one company having issues in this field or pulling guidance for 2025 or adjusting it. It's the whole sector. And as we know, the pendulum will swing to ultra bullish in the markets, and this pendulum will also swing like it did in April to ultra bearish, negative, everything's crashing, the world is ending. And we have to understand that for sectors as well. And right now, we are in healthcare or health insurance as we know it is going to cease to exist immediately. Now, that's pretty irrational, and that is absolutely crazy. That is not the case, and that is not what's going to happen. Okay. Health insurance is the biggest job, one of the biggest job creators in the whole United States, in the whole world. It's such a massive field and sector. It's not going away. Okay. It's needed. You don't want to have to pay $10,000 for an MRI out of your pocket. You rather pay a small amount monthly to a health insurance company so you don't have to pay that lump sum. Okay. So yeah, just wanted to give you like an overview of what this is going to be, everybody, and my mindset about this stuff. But if we go back into Oscar's high five snapshot, we already know that they're going to be doing 12 to 12.3 billion dollars in revenue this year. That's a 32% revenue growth. That's massive. That's putting them back on the map as a massive growth company. And as a massive growth company doing 30% revenue per year, we're going to have to see what they do next year. I have them pegged as like a slight decrease due to ACA subsidy pressure and some other things. But if they come back out and do 15, 20, 30% next year as well, then we're full blown. They don't care, like full blown growth story. Crazy. Yeah, the high five snapshot's pretty basic, guys. Right here, you have your discounted cash flow model. Right here, you have your discounted cash flow model, fair value of $65 per share. It's a 78% margin of safety. Margin of safety is essentially just from taking it from your fair value down to the current stock price. So the current stock price of $14.45 is 78% under your $65 fair value. You come down here to EPS. If they have a good EPS year next year, which they're going to be negative this year. If they have a good EPS next year, then they're $31 fair value there. PE will get back to normal in 2026 once they go EPS positive. And the biggest reason they're not EPS positive is because of medical loss ratios. And I'll actually show you something here in a minute about medical loss ratios that I haven't heard many people talk about. But I have been talking about, how the pendulum swings and a lot of things. The pendulum swings from ultra bearish to ultra bullish on, the stock market. It swings this way for stocks that you're trading. It swings this way for the thesis and the sentiment. It swings this way for a lot of things, including medical loss ratio. The mean, and I'll just pull it up now. So if we look here, the medical loss ratio mean is 0.80, 80%. So medical loss ratio is essentially how much a health insurance company is paying out in premiums, how many claims they're taking in, and another wide array of factors. There's a ton of factors that go into it. But essentially, what you need to understand is it's essentially, think of it like interest. Now, interest constantly flows. We in 2020 we were super low interest rates, and now we're super high interest rates if you want to buy a home, right? So it's the same thing with the medical loss ratio. It swings. Sometimes it's very cheap, sometimes it's very expensive. You can see that at the peak in Q3 2021, we got up to basically a medical loss ratio of one. And at its trough in 2020 Q2, we got down to 60. But on average, across the board, we have a medical loss ratio of 80%. 80% is your steady flow, and that is typically the average that you're going to have across the board. Okay, you can just look at it on the chart. So, with that being said, we don't have the updated numbers right here on this. They haven't updated on this site yet, Visual Stocks. But we know, or they haven't had Q2 yet, right? But we know in quarter two, they've actually spiked back up to 87 to 88%. So you see, we were troughed in Q1, 74, 79, 85%, and then 88% at the last quarter of 2024. This year, we started again low at the 75% mark. But now, instead of 79% medical loss ratio, we're jumping straight up to 87 to 88% medical loss ratio, which is massive. And that is why we're having a negative EPS quarter, because they were expecting something along the lines of 0.80, and they got a massive spike, and all health insurance companies got a massive spike up to 87 to 88%, ranging across different companies like UNH and Blue Cross. It's different, but it's all elevated, basically. It's all elevated. And the biggest thing I just wanted to show you on this chart, guys, though, is that it ebbs and flows. It ebbs and flows, but as you can see, over the majority, you get an average of 80%. So understanding that the average is 80%, you can easily understand that being at 87, 88 right now, which is way more than it was the last 3 years. 1, 2, 3, 4. The last 4 years on this quarter, the Q2 quarter, last 4 years, it's been 79, 80, 82, and 82%. And this year, right? This year, it's 87 to 88%. A massive, massive spike there. So we just have to understand that they can't control this. This is something just in the health insurance industry. It's something we have to live with as investors and shareholders, but it's all about how management and leadership manage this and handle this going forward. So again, because of that, they're going to be EPS negative, but the pendulum is swinging to that ultra crazy, like 87, 88, 90 area, but it will also swing back down to that lower area of 70s or 80, which is the mean, which is the average, right? So, yeah, at the end of the day, guys, if you punch in crazy numbers in here, which this is already a very conservative, this is my base case scenario right here. This is base case, not even, I mean, it could be bear case or base case, honestly. It's just very undervalued. Look at this. I'm doing free cash flow margin of 5% for this next 5 years. and 10% for the last 5 years, basically meaning on every dollar they pull in for revenue, they're getting 5% to go to free cash flow or 10% to go into free cash flow. But if we go back to visual stocks, we can actually see that they are pulling in. Let's see, was it this site or the other site? I think it was the other site. There it is. Free cash flow, 11.8%. So right now they're doing 11.8% margin for free cash flow. So for the next 10 years, I have them doing 10% or less. So you see, I'm really beating this up, and it's still $65 fair value. And I have the revenue growth rate here sub, basically in the teens, low teens, or single digits. And again, if we go here and we go to estimates for revenue, let's do. Yeah, we'll do revenue. The site doesn't show. Why doesn't it show? Whatever. They're expecting, like, obviously, like we know, they're getting 12 billion this year. What's up, Steven? 12 billion this year, and then next year they're expecting a small dip, and then 2027 we know that Mark Bertolini has said that they are going to be getting they should be able to get 14 billion in revenue for 2027, and he's talking about what was it, 3 to 5% margins on that. So taking that as free cash flow, obviously that's going to be massive as well. And if we look at free cash flow here, they're expecting a small dip in 2025 due to obviously higher medical loss ratio. Looking, what's up, Rambler? 2026, they're expecting, negative free cash flow, I suppose. I don't really think that's going to be the case. And then they're expecting 2027 for us to spike back up to 1.2, 1.3 billion dollars. So across the board, revenue growth rates, 30%, and then with very conservative assumptions, we're severely undervalued. But overall, that's how I really look into companies. Beyond that, I look into quarterly reports. I look into annual reports. I listen to conference calls. I listen to interviews. You just you gotta be a stalker girlfriend with the stock, and just, yeah, you gotta stalk the stock and just try to learn everything about them, the company, the leadership, everything. You really gotta stalk it, and just don't stop until you know everything. All the risks, all the rewards, all the bad things that can happen, so on and so forth. So I don't want to talk about Oscar this whole video. We'll jump on over to HIMS. So HIMS also very undervalued. If we just look at the revenue growth rates expected to be in basically 20% plus revenue growth rates over the next 10 years, we can clearly see that we are having massive revenue growth over the next 10 years, getting to almost $12 billion by 2033, and getting to 12 almost $12 billion in 2033. We can see with a 17% free cash flow margin rate, which, if we want to look at what HIM's current free cash flow margin rate is, we can just look over here on Fiscal AI. We can go to the overview, and we can see that their free cash flow margin rate as of right now is 14%. So as of right now, over the next 5 years, I have them doing 13% free cash flow margin rate, where right now they're doing more than 14%. And then I have a slight growth up to 17% for the last 5 years of this total analysis, getting them to 17%. And overall, if that were the case, then we are looking at a fair value on HIMS and hers of $680 essentially in 2033, based on them getting to almost 12 billion in revenue, which obviously is a massive gain from here. Yes, it's 10 years. Yes, that's a long time. Yes, a lot of things can change and get in the way of that. And no, every year probably isn't going to be perfectly like this, but this is why you run multiple cases, and you know, try to buy it at the lowest margin of safety. Right now, we're still at a 33% margin of safety, which is $57.65. But in April, we were just at a 70% margin of safety because we were sub $30 per share in April. So April was the time to be buying HIMS. You could still buy HIMS today and still be getting 33% margin of safety. You're just getting less margin of safety. You're taking on more risk by buying today because they could always go back. It's a very volatile stock. They could always go back down to 60, 70% margin of safety, 100%. There's a lot of things that can happen. They could have a lawsuit filed against them with the whole Nova Nordisk thing taking place and them axing them, and that whole relationship kind of just derailing itself, right? But yeah, again, can you analyze a stock that is not a good investment? Yeah, for sure. Yeah, we can let me finish HIMS and then we'll look into a stock that, I would say is not a good investment. And Svetlin we're gonna look at Palantir. We're gonna look at Palantir, buddy, because we were just talking about it in the community today, right? We were talking about your Palantir position and what I would be doing there. And we came to the agreement that probably it's best to trim some right now. So yeah, we'll talk about Palantir here in a minute. But so as you can see, Hims and Hers, it's not like Oscar where it's like a deep buy on the free cash flow yield, free cash flow, EPS, across the board. Hims is a massive growth company. And as a massive growth company, the two best metrics to value a massive growth company like a Hims and Hers is going to be your discounted cash flow and PEG ratio, price to earnings growth. So we can see that fair value, intrinsic value of Hims and Hers is $86 per share on conservative numbers. The PEG ratio is 0.53. Anything below 1 is really good. The farther down of 1 you get, the better. Because they're having 200% earnings or EPS growth this year in 2025, you get a 0.53 PEG ratio, price to earnings growth. Okay? So that is how you value growth companies. And now you can understand a little bit more with Oscar how the PEG ratio, EPS growth rates, right, which are getting delayed from 2025 to 2026 essentially, and discounted cash flow model are the best ways to value these companies. You want to know what other companies were great buys based on discounted cash flow, rule of 40, and PEG ratios? You want to know? Nvidia, Palantir, Robinhood, SoFi, all of those companies from 2023, 2024, 2025, on all the dips, all the pullbacks, they were massive buys if you were looking at the right place. If you were looking, let me talk to you. If you were looking at Robinhood, Palantir, SoFi, Nvidia, if you were looking at these massive growth stories and sat there and said, okay, they're growing 20% plus revenue growth consistently right now. Consistently. They're pulling in this much free cash flow. Their EPS story might not be there yet. Basically talking about a PE ratio because the most known metric is price to earnings ratio. Well, guess what? It's really hard to determine what price to earnings ratio you give a company like a Palantir or a Nvidia when they're growing exponentially. When you sit there and say with Palantir, like I did, when they were doing 30% revenue growth in a quarter, and you sat there and said, like myself, there's no way they're going to do more growth than 30% revenue growth quarter over quarter, year over year. And then they come out with 35% revenue growth. And then you say the same thing. Their PE is crazy. There's no way they're going to do more revenue growth. There's no way. Boom. 40% revenue growth for a Palantir Or Nvidia is even crazier. 60, 80, 100% revenue growth year over year. Are you kidding me? It can get insane. You don't know. With growth companies, what you really want to be looking at is quarter over quarter, right? Once you see on quarter over quarter revenue growth continue to expand and grow and grow and grow, once you see that one quarter that comes in and brick wall, now Palantir isn't growing 40% anymore. Bam, they're growing 35% now. They had a quarter over quarter deceleration in growth. When you have a deceleration in growth for a massive growth company like an Nvidia, Palantir, or Robinhood, that is when, as an investor, you have to realize that we may be taking a turn, because now the PE and the hype and all the things going on in the momentum could stall out. When momentum stalls out and the story changes, and oh my gosh, they're not going to be able to do 50% revenue now. They're not going to maintain 40%. First thing people look at is valuation. They go growth, 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 growth. And then once it slows quarter over quarter or stops, boom, straight to valuation. What do the numbers tell me? When that happens, they're not just boom, straight to valuation. They're boom, I need to sell. I need to take gains. I need to take profits. And that's where you see the masses and the hedge funds and everybody say, okay, taking profits like crazy. And the next thing you know, you have a giant pullback on a stock. When that happens with a Palantir, that quarter over quarter growth stalls from 40% down to 35%, you are going to see a massive 10, 20, 30% pullback. Not in a day, but you will see it. It just needs to start. Okay. So as a smart investor, we'll look into Palantir here in a minute. As a smart investor, you really need to understand this and look into this. Okay. And understand how to value a PayPal that has single digit growth, and how to value a growth company. There's different levels to this game. You cannot give PayPal a 30 PE. You cannot say PayPal is undervalued because they're a growth company. You can say that before this huge run up in Robinhood and Nvidia and Palantir. You could say that before. And what did you need to be looking at? Not just revenue growth. You need to be looking at that free cash flow. How much money are they bringing in? What's their discounted cash flow fair value, intrinsic value, based on their next 10 years of free cash flow? Because if they're growing like crazy, they're going to continue to bring in that cash on the free cash flow. And this is what they should be valued at. So to reiterate, you value growth companies around discounted cash flow, rule of 40, PEG ratio, and consistent revenue growth. And you're looking out for that stall quarter over quarter, year over year, looking for that brick wall to hit. And maybe even 2 quarters in a row of decelerating revenue growth, then you really know, okay, tides are turning. We saw it with Tesla. As soon as that happened in the 4,500s, bam, straight to valuation. Okay, I need to trim. Shot down. Hasn't seen those levels since. So, make sure I don't stuff my mustache. So, with HIMS, that's how you value it. You value it based off that revenue growth, you value it based off the PEG ratio, and you value it based off the discounted cash flow model. Same thing with Oscar. Oscar is going to do 30 to 33% revenue growth this year. I think they can grow 20% plus for the years to come, because they're such a small guy and the total addressable market is in the trillions for the healthcare sector. Like a company like United Health Group is literally a $300 billion market cap. They were once upon a time $500 to $600 billion market cap. I appreciate that, John. This guy's a great teacher. Still interested in Ronnie's thoughts on CMPS. Yeah, I'll look through it at the end. I appreciate that though. I love teaching. I love helping you guys out with all of this. And just so you guys know, I was self-taught everything. So if you think you can't self-teach yourself, or and I say self-taught meaning like I seeked out the information. There was somebody like me talking to you, but I was in your guys' shoes. I was in your guys' seat. I was the one watching. I was the one reading books. I was the one taking in the information, understanding it, right? At a high level, consistently learning and learning and learning. And then now I'm at a point where I've been doing it for 10 years, still learning. You're never going to stop learning in the stock market. You will always be learning in the stock market, whether it's trading, whether it's investing, whatever it is. But you don't need a degree to do this. Okay. You don't need to go to Harvard. You don't need to go to business school. You don't need a master's. I'm working on my master's right now, but I took a pause on it because social media has been blowing up. Right. And I, this is my passion. I love doing this. I was on route to get my finance master's degree at Liberty University, and I kind of hit the pause button on that because this is I like this more. Eventually, I'll go back and finish it. I just don't have the time right now with my family and doing this. And I just love this a lot more. I love trading. I love investing. I love having all of you guys here. And I love just helping you guys learn, right? I don't need that degree to teach me the black and white when I already know and have done it hands on for over 10 years. So, did you ever pay extra for information like seeking out for premium? Um, Did you ever pay extra for information like seeking out for premium? Seeking out for premium, are you talking about like covered calls, cash secured puts and stuff? Rambler. Um, I've definitely spent money before in my journey to learn from people, to be part of communities. I've definitely done that in the past. And I think that helps accelerate things for sure. I have a community. It's the High Five community. We teach investing, trading. We teach a lot, right? You don't have to come do that. I'm always going to give out free information. You can always be here and get free information from me. But if you want to accelerate things, there is a community, and that's where I give more because I can also only give so much for free. Okay. It's nothing personal. It's just life. I have a family that I have to look after, and I have to take care of. So it's nothing personal. It's just it's how it is, Like if I'm going to take time away from them to do more, then there has to be some kind of, you know, payment. There has to be something there, right? I'm just talking about general information like paying extra for a Grok Super. Grok Super. Yeah, I don't know. I don't know. I can tell you that being a content creator, I have a bunch of different subscriptions to a lot of different stuff, including like Seeking Alpha and Trading View. So it definitely costs. It costs money to be able to. Yeah, I mean, I know like Bloomberg Terminal is like thousands of dollars. I don't have that, or it's tens of thousands of dollars or something like that. I don't have that. I don't think you need it, but the whales, they have it. Getting all that information first and foremost. Which EPS or DCF has greater weight than when you analyze the company? So again, I think Svetlana, I think I answered that like a minute ago. For me personally, I love discounted cash flow model, but if you can get good discounted cash flow model, a good PE, a good earnings per share, if you can get all these metrics, right? Your free cash flow yield, discounted cash flow model, EPS, PE, PEG ratio, if you can get it all to line up, then you're like flashing green, like buy, right? But, if it's something like HIMS, where these should actually be red or yellow because they're 1.4 and 1.5. If it's something like HIMS and you see, okay, price to earnings ratio is high at 93 to 106, but is it high? Because they're growing 20% revenue per year and they're a disruptor. They're massively growing their user base, their subscriptions. So you have to look at a growth company like Hims and Hers at the PEG ratio, discounted cash flow model, and you have to take more weight into that rather than um, the EPS. I'll show you real quick. We'll look at Robinhood and we will look at Palantir. Oh, I was supposed to be showing. I hate when I do that. I was supposed to be showing you the chart, but it's okay. I'm going to show you Palantir and Robinhood real quick. Okay, so EPS or DCF has greater weight when you analyze the company. Okay, you ready for this? So, one of the biggest mistakes I made in 2024 and 2025 was actually opportunity cost. I missed out on Robinhood. I missed out on them. I had a chance to buy them at $19 per share, and probably even lower than that. But when I really was looking into them and sitting there saying, okay, this is actually an undervalued company based off of the discounted cash flow model. Based off the discounted cash flow model, at one point, it was a 40 to 50% margin of safety, and it was $19 per share where I should have been buying. You can see that we are now up to almost $105 per share. And I kind of want to get back to that. Can I get back to that? Probably. There we go. So it was, let's put a 15 in there because I think I did have them as like a 15 PE or 15 terminal free cash flow model at the end of this 10-year analysis. So yeah, it was like right here, 40 to 50% margin of safety. Once upon a time, if we look at the chart, let's see. This was it was in 2024. It was the end of 2024, right in here. We were at sorry, it was down here. It was down here. End of 2024, we were at that $19 area. We revisited this $30 to $20 area here. These were your great buying opportunities, right? These were your two great buying opportunities. Why? Because the discounted cash flow model told you that anything basically under 36 was a buy. Under 36 was a buy, but you basically got 10% margin of safety, 20% margin of safety. Me personally, I like buying 20% margin of safety or lower. If I can get 20% margin of safety or lower, then I'm going to keep buying the company because that's giving me a 20% margin of safety, right? It's giving me like that buffer, that safety cushion to basically, if I'm wrong a little bit on the projections, and I usually buy off like conservative projections too. So it's like a double whammy. You're getting that 20% margin of safety and you're being conservative. You're not being crazy. You can get a crazy, you can throw in crazy numbers into this thing. But you shouldn't be like, you shouldn't punch in the rosiest of assumptions of everything and then turn around and say, yeah, these are all going to come true. You know what I mean? You got to be conservative when throwing these numbers in. But back to what I was saying. If at that time you wanted to get into Robinhood, you knew that the growth was crazy 30%, 24%, 16%. Then it drops down here. We don't know what the growth is going to be. It could continue to be crazy. But as of right now, we know it's crazy for now and it might decelerate later. But it wasn't an EPS story, right? It was slightly growing EPS, but nothing crazy. Well, actually, this year grew 150%. So there you go again. You have a name that you should have been buying. If you would have sat here and said PE, you'd have been like, PE is too much, too high. Free cash flow yield, too low, too low. I want 3% or higher. If you sat here and said, I'll buy off the discounted cash flow, which was 36, you could have been buying in 28, 25, 21, 19 bucks, and you would have been getting 40 to 50% margin of safety. Great time to be buying. I don't know why I didn't buy. I was an idiot. Honestly, don't know. I think I looked into it and then life happened, things happened, and I didn't hit the buy button. I regret it because you see now It's crazy. It's $105. It would have been a massive opportunity, a 5x from 19, obviously. But peg ratio being 45, 0.45 under 1, and then also your intrinsic value being 36 at that time. Again, at that time, you can just obviously see that it was undervalued. Sorry about that. It was undervalued, and that was the time to be buying. Should you buy it now? I'm not buying now. 8 to 10% revenue growth from 2028 to 2034 is what I think they'll do. Somewhere in that is what analysts think they'll do. I don't know. I don't think they can keep growing 15, 20, 30%, anything like that. If they can, then things do change. Let's just say 20, 20, 20, 25, 20. If they can grow there, see, now we're throwing in rosy assumptions. Let's just say 20 across the board. They do 20% per year. You see how euphoric Robinhood is getting, right? We had a high of $113. We have a current price of almost $105 per share. And you see that with 20% revenue growth per year, which analysts think they can do 8 to 10% from 2030 on. We do 20%, which again, that's getting crazy. That's being bull to ultra bull case there. Still, we're basically at fair valuation today. At fair valuation today. So you just have to, you gotta, am I investing in the high five investing community? You get access to this. You can run your own projections. You can run your own numbers. I teach you how to do it. I teach you how I look at it, everything. But yeah, that is why I'm not buying Robinhood today. But I'll also sit here and say, I effed up not buying Robinhood at $19 per share. But it's okay. You're not going to get every single investment right. You're also not going to be in every single investment. I also was not in ASTS or Rocket Lab, and I traded them and I made some good gains trading them, but I did not get in them as an investment. Those, right? So we talked about, PayPal's like value companies, like how to do those. Let me talk to you again. We talked about PayPal and how to value those companies, right? And you're not going to give it a 30 PE, you're going to give it like a 10 PE, maybe a 15, and you're going to value it like very, very conservative because they're not growing like crazy. But like a Hims, a Palantir, Nvidia, Oscar, they are growing 20, 30 plus % revenue growth per year. So you're going to value those not based off PE, you're going to value those based off of peg ratio, rule of 40, their consistent revenue growth consistently being there. Like Celsius, you saw what happened. Consistent revenue growth fell off a cliff, and so did the stock price, right? So you do it by peg ratio, price to earnings growth, and discounted cash flow model, and their growth quarter over quarter, year over year for growth companies. Now, companies like, oh man, I just freaking squirreled right there. I forgot what I was just saying, what company I was talking about. I was going somewhere with that. Value company, that's how you value it. Growth companies, that's how you value it. And then what company did I just also say? I completely dropped it out of my brain. Don't know. We'll press. Drop it in the comments if you know what stock I was just getting into and talking about. But yeah, Robinhood missed the boat on that. Should have been buying at 19. I didn't. You're not gonna hit every stock. But getting into Palantir. And again, like this is the first episode. I know we're going long here. It's 49 minutes. We're gonna wrap up soon because I don't have all day. I gotta watch the kiddos while the wife goes out and gets some her time. But yeah, we're just chit chat, we're just talking, and we're just trying to get to add SoFi. I'll get into that here in a minute. I'm just trying to show you guys my mental thought process around investing and stuff like that. We'll get more structured as the series continues, as we go forward in the due diligence series and looking into individual companies. You guys giving me companies to look into, me running them through the high five snapshot, and also just maybe looking in 10Qs, 10Ks, and answering your guys' questions like, hey, what do I look for in an income statement? What do I look for in a balance sheet? What do I look for in a cash flow statement? How do I value a company? Which is mainly what we're talking about today with everything, right? But Palantir for Svetlin, do your commercial on your fees? Sorry, John, I don't know what you're saying there. Which do you favor? I favor discounted cash flow model, but I look for companies with discounted cash flow model, PE, PEG. I look for, like, the more I can get, the better. So it's like trading. The more indicators I can get going my way, the better. But curious, how much was your first initial investment of your first high conviction stock? I'm just curious from your point of view because you're more green back in. How much was your first initial investment of your first high conviction stock? Um, it was, what was it? I'll be honest, my first real high conviction stock, like once I really knew what I was doing in the markets, like as an investor and everything, my first high conviction, like real high conviction stock was actually Tesla. It was Tesla in 2018, 2017, 2018. I was a big buyer of Tesla. I just kept on dollar cost averaging. We ended up selling our house at the time because we were moving. I was moving duty locations. I was in the Air Force at the time, and when we sold that house, I took a lot of that money and I pummeled it into dollar cost averaging consistently into Tesla. And then Tesla rewarded me with over 1,000% gain. It was it was crazy. Like, it was crazy. Yeah, it was my best performing stock ever at that time as an investment. It took $11,000 into over $300,000. Like, very, basically during the crazy COVID times. Yeah, it just absolutely rocketed up after that and kept going and going and going. I eventually sold around 4 to 500 area up there because I knew that the stock price was running away from the fundamentals. And because the stock price was running away from the fundamentals, that told me that, hey, we can do a couple things here. I can either keep trimming as we go, or I can sit here and say, you know what, I'm just gonna call it, and I'm gonna get into a different company, or I'm gonna spread this out into different companies. At the same time, guys, like at that time, you know, $300,000 was a lot of money to me, a lot of money. So I'm sitting there like, okay, I don't want to lose this $300,000. It sucked having to pay the taxes on it. But again, you just have to sometimes, like, and this is what I'm saying about Robinhood and Palantir right now. You have to realize that Palantir, more than Robinhood, Palantir might not see $160 per share again in a very long time, years. Because if we look at Tesla, I'll pull up a chart. If we look at Tesla, oh yeah, Eli, thanks for that. Yeah, everybody smash that like button. Subscribe if you're not subscribed yet. If you're watching this on X, go to my YouTube, subscribe, hit the like on X too. I appreciate you guys. I'm trying to grow. I'm trying to get to more people. I feel like this information is really good for a lot of people, just helping out. A lot of people don't talk about this or do live streams on like the boring stuff of like fundamentals and everything, and I enjoy it. And I know a lot of you enjoy it, or you wouldn't be here on a Saturday. So let's spread the word. Let's get it out, share it, like it, do all that good jazz. Let's get it out there, guys. But hey, yeah, Tesla, I lied. I said it didn't get back to there, but it did, right? So I was buying, yeah, it's kind of crazy to look at the chart. So I was buying back here 2017, 2018 for like 15 to 32 bucks. 15 to 30 bucks per share on a split adjusted basis because they've split like 3 times since then. We ran up during like right after COVID. We had a pullback, and then we had our blow off top in the market up to $400. I was selling in here. I didn't sell the top perfectly. Doesn't, man, I'm not showing my screen. I'm sorry, guys. Jeez. All right. Thanks. Yeah, so 15 to 30, right, for Tesla back in 2017, 2018. We ran up here in 2021, had a pullback, then we had our blow off top. At the blow off top is when Tesla just got absolutely crazy on the fundamentals, or absolutely crazy on the valuation compared to the fundamentals. And so I didn't sell up here at the top. I sold in here somewhere. I sold in there. And then guess what? When we came back down to earth, basically around $100 per share, I was buying in this range again. I was buying here, and then I was holding, and then I think I trimmed some up here because again, just based off the fundamentals, they're really getting away from the company. And then I actually popped more down here again, and then sold more up here. And now I don't hold any Tesla right now. I like the story. I like the robo taxis. I like Optimus story and everything, but I just think the valuation isn't quite there. And I think that we could, pull back below the 200 week moving average back down to like 260, 250. Under 300, I'd probably be interested in buying this again. Basically where it was back in April. So yeah, because the story is really good, but the fundamentals don't line up with the story. They just did like 215 million in free cash flow. Absolutely pathetic. Absolutely pathetic for a $1 trillion company. $215 million in free cash flow in a quarter. Pathetic. Okay. But Elon is just getting back away from all the political stuff and just getting back to pushing the company back in the right direction. So, all right, Palantir. It's a trim of 55%. Nope, it's a trim of 60% now. So it had another massive day on Friday. And the reason it's a trim of 60% is because you have current margin of safety and you have current margin of risk. Current margin of safety in my book, again, is buying underneath the fair value of the company on conservative numbers. Margin of risk is selling a company when the price gets away from the fundamentals. When the price gets away from the fundamentals and you run bullish projections, it's time to start trimming. Right now, Palantir is a 60% trim if I was holding them today. And you could see that the PEG ratio, or the PE is 378 current, 284 forward PE, 0.31% free cash flow yield. With a 36% EPS growth rate, they're rocking a 10.5 PEG ratio. Remember, I told you there's 2 ways to value growth companies. It's discounted cash flow model and PEG ratio. And then after that, like I said, you're just looking for this quarter over quarter growth. Eventually, in the next couple quarters or within the next year, I don't see Palantir going from 40% to 45% to 50%. I see them going from 40%, maybe up to 45%, and then 40%, 35%, 30%, come back to earth. Because you got to realize them doing 40% the last few quarters means that they've done massive growth. Meaning to do that same 40% that next year, year over year, they have to do even more massive growth, crazier growth. Because they did that 40% last year or last quarter. Now they got to do even more, right? Like the compounding of like 40% and then 40%, then 40% is just crazy. It's like 40%, then 80%, then 120%. It's insane, okay? And it's not sustainable. It's not sustainable. So I don't know when they're going to stop that growth, but if I had to guess, I would say the next few quarters or within the next year, they'll have a quarter over quarter deceleration in growth. When they have that, I think you see the stock massively pull back. Okay. It's not going to crash, anything like that. But again, what are people going to do? Boom. Fundamentals. Everybody knows the P. Everybody knows on every metric free cash flow yield, PEG ratio, or PEG ratio, for PE, forward PE, discounted cash flow model. Oh, EPS, yeah, should be $87 per share with 121 PE for next year. Okay, yeah, it's crazy. Svetlin, we were talking about it. I would trim probably 60%. I'd probably trim 60% of your position, and then maybe you sit there and say, 40% I'm going to hold forever. Do I believe Palantir can be a $1 trillion company? Yes, I do. Eventually. It's going to take, just like Tesla, when they hit that peak and they fall, they are going to fall and fall and fall and fall. And then they're going to have to base out because they're not just going to snap back up to doing that type of revenue growth, right? They're going to base out, and then it's going to take a while to get back to these levels. Why is it going to take a while to get back to $160 per share and a $375 billion market cap? Well, that's because they're doing less than $3 billion in revenue this year on a trailing month. They're doing $4 billion, but at the end of 2025, they're doing $4 billion in revenue. They're at 1.1 billion, 1.14 billion in free cash flow. But yet they're a $375 billion company. They're doing 1 in 374th of their market cap and free cash flow. Meanwhile, Oscar is doing 1/3 of their 1/3 or 1/4, depending on the day, of their free cash flow compared to their market cap. And they're growing 30%. They just grew 30 to 32% in 2025. Are they as exciting as Palantir? No. Am I trying to say like the business models are the same? Absolutely not. Health insurance versus Palantir with AIP, obviously very different. Okay. I'm just saying, Palantir right now, you got to realize that, man, it's going back to the chart. I sold Tesla up here somewhere. And from there, when people said valuation, it dropped from its peak 75%. I had $300,000 in gains on Tesla. $300,000 in gains on Tesla. If I didn't sell up here and I held on, I would have held on. I would have had to hold on for 1,113 days before we got back to where we were. So 2 to 3 years to get back to where I was with my gains. You see how dumb that is, right? You see how dumb that is. I have $300,000 in profits on Tesla, over 1,000% gain. You realize the fundamentals aren't there. You realize that the growth will slow. Or you see what happened with Tesla, where the story's great and all, but things started to rapidly change. They weren't doing as good as they once were. And you could see it all up and down the fundamentals. And you can see it with Elon Musk. So if you didn't sell, those 300,000 in gains would have dropped down to, I don't even know, like 100 or less than $200,000 in gains, which is still good, but like, again, then you would have had to wait almost 2 to 3 years before you got back to where you were. And then guess what? You could sit here and say, well, yeah, but then you would have got another 35% in gains. Okay. Another 35% in gains. All right. Well, that took 3 years. So 35% in gains over 3 years, that's 11%. So that's 11% CAGR. That's great. That's great. But again, you could have locked in back here. And then how much? So that $300,000 here got me into all these other stocks like Meta and Nvidia and Palantir, and it made me a whole lot more money. You gotta think about this. You gotta think about this, guys. Selling Tesla here isn't just like, oh, well, I sold here and I missed out on this. No. You sold Tesla here, like I did, $300,000 from 11,000, and then I went and invested into Palantir, Nvidia, uh, who else? Meta at like not even at 88 and at like 100, 200. And those have gotten me massive returns since then. So it's opportunity cost as well. Right now, being in Palantir, do you think you're going to get a 10 to 12 to 15 to 30% annual CAGR, compound annual growth rate per year? Do you think you're going to get that with Palantir? I don't think you are. I don't think you are. Is there an abundance of great opportunities in the market right now? No. But there's a sector that is a very, very great opportunity right now. There's blood in the streets in this sector. Nobody wants to touch this sector. Everybody wants to wait until it's, things are better and things aren't as crappy. But by that time, the markets are forward thinking. They're forward looking. By the time the healthcare sector and the health insurance sector gets back to, this is great, everything's fine, it's already going to have ran 50% or something. I'm telling you, it's forward thinking. Once things get not as bad, things are like bad right now. Once things get like, they're bad, but not like bad, then you're going to see a massive turnaround already. And then you're going to sit there and wait. Okay, just going to wait for, some bills, some policies to come out for healthcare, for health insurance. Just going to wait for Trump to say something about it. Just going to do this, blah, blah, blah. And then bam, like it's gone. And then you're buying much higher prices. Still an opportunity there, but not as great of one. So yeah, right here could be Tesla 2.0 with Palantir. And again, it's just like, yeah, how do they get to $1 trillion? They have to keep up these crazy revenue growth rates, guys. Nvidia, let me scroll back, make sure anybody else, because we're about to wrap it up. Do you cover ANET at all? I think you asked me that last weekend. Thanks for coming back. Maybe you asked me that yesterday. Oh, there's ANET. It's not the updated high five snapshot. This is my older one. I haven't updated it yet. But yeah, let's see. So I'll actually show you guys how I would like run it. ANET. I'm gonna feed these numbers in here, make sure they're updated. ANET's doing 51% annual or 51% free cash flow. This is way off. I don't know why this is so low. If they're doing that, that's crazy. Okay, so let's do 50% and then 55% for the last 5 years. That's insane. There's no way that's accurate. Ain't no way that's accurate on ANET. Free cash flow. Ain't no way that's accurate. Hold on, let me double check. I don't think that's accurate. Financials, cash flow. Let's see. All right. Yeah, they're gonna do oh wait, no. 3 point nope. 3.785 divided by, sorry, drag this over here. Current revenue. Wow. Okay. Yeah, it is 70. It is. Holy moly. Okay. We're gonna run the stream a little bit longer, Hunter, because dang. All right, real quick, we're gonna do one of these. We're just gonna start a new one. All right. Let's see. You guys can actually see me do one start to finish. All right. So move copy. AVPT. Oh, the wife's got to leave at 2:20. It's 2:12. I'm about to get yelled at. Hey, Net. Last one. Real quick. Let's speed through it. Hey, Net. We got to know. We got to know. So ANET, they're doing, what I say? They're doing 54%. Let's just call it 50 and 55% forward. Let's call it 15 PE or 15 terminal free cash flow yield. So I just pull these numbers off here. Let's see, financials, income statement. Let's see, earnings. No, financials, income, 7 billion last year. 0.003. Free cash flow was what I say it was. It was 3 point some billion. Free cash flow for 2024, 3.676 billion in free cash flow. Stock-based compensation. So that's how much stock they're issuing out. Issuance of capital stock, actually very low. 0.063 for 63 million. Let's look at our net to net debt ratio. Go to balance sheet. We look at 8.149 billion. 8.149 billion in total cash and investments. We scroll down into net debt minus 8.149.6. Sorry, I messed it up there, but basically it's zero. We'll call it zero because they even out. The net cash, the net debt, it's a break even. So we'll just say zero there. How many shares outstanding? Let's see. I think it actually was on here. Shares. They have 1.2566 shares outstanding. I don't know what their price to sales ratio is right now. 2.56. So let's look at their EPS. On their EPS, we're looking at 2024 of $2.27. For this year, they're going to do $2.57. So they have a 50 current PE, 44.5 forward PE. They're looking to do 13% in free cash flow or EPS growth this year. So that's not a great PEG ratio right there at all. That's all good. And then we need to punch in our revenue growth rates. So revenue growth rates, we're going to do 20%, 20%, 18, 18, 20. Drop it down to 9. And we're just guesstimating here. We'll drop down to 7, and then we'll bounce back up to 10, 12, 10. Okay. So at 10 to 20% ANET being a moat, I would give them a 25 terminal value. Their current terminal value for free cash flow is valuation cash flow, or here's the price to sales. Where's it at? Boom. 19, so not that great. No, I don't have it. All right, so let me run the EPS numbers actually. Earnings estimates. Let's do 20, let's do 13, 17, 21, 22, 7, 10, 15, 13, 11, 12, 10. Let's do 30 PE. And then we'll go down to 25. All right, so ANET, we're looking here. Not, yeah, that other one was just old. That other one was old. So for ANET, Hunter, is it a buy today? Yes, they're undervalued. $127 fair value based on discounted cash flow model. But your EPS is lacking. You're looking at a $90 to $110 fair value. So you're basically, I would say, buying today at fair value. I think there's better opportunities in the market. Again, it does depend on what you believe their revenue growth rate is. If you believe they can sustain above 10 to 15, right, then you jump up to a 21% margin of safety. Either way you spin it, it's not like a screaming deal, but it's a good deal. Okay, it's a good deal. All right. You forgot Zeta. Yes, I did. Zeta. We've already went over this one a lot. But I plan on putting out a video on Zeta, like a deeper dive video on Zeta, and going over this more. But same thing here, guys. You can see that again. What do I look for in a great, fundamentally undervalued company that I could buy today? Free cash flow yield, good. 3% plus is what I look for. Really 2%, but 3. The higher you get, the better you get. PE ratio 22 forward, 24 current. Great. PEG ratio 0.39. Amazing. That's amazing right there. Let's just 0.56. Same. Discounted cash flow model $26 fair value. $10 current price is $10 underneath the discounted cash flow models fair value. And then if we look at EPS is a buy too. 2025, your fair value is $17.27. For 2026, your fair value is $22.62, meaning you are getting between, so basically for 2026, you should be paying, fair value is between $23 and $26 per share, and we're currently at 16. So massive opportunity of 40% in the next year. Again, average, you're getting 8 to 9% return on the overall market yearly. You're looking at a 14% discounted cash flow annual CAGR for the next 10 years and an 11.5%, 12% annual CAGR of EPS for the next 10 years. Looks really good. Looks really good. And guess what? Their growth is really good as well. Mid to high teens. DLO is also the same. I'm coming right up. I'm about to yell that. DLO, even better deal here. You can see free cash flow yield is 3.5 to 6. PE 17 forward, 21 current, 1 peg ratio. So not the greatest there. But you see also they are expected to grow mid or really high teens to 20% plus over the next 10 years. And yeah, the EPS is just crazy too. I mean, $18 fair value as of today. They're currently $10.83, $21 fair value. So $18 to $21 fair value on DLO, and they're currently sitting under $11 per share. So I hope this was insightful, guys. I hope this was good. John Ray, CMPS. I'm going to add it. I'm going to add it over here. That way I don't forget. Just like I did with ANET. I'm going to put it right in here. Let's see. Move copy. I know I'm not showing the screen. It's fine. I'm just adding it so I don't forget. If I add it in here, I'll run the numbers for it eventually when I get time. And then I'll be able to post about it. Where are we at? There it is. Create copy. It is CMPS. You got it. I will look into that one and comment below on this video afterwards. That way it actually is a comment underneath the live stream video. If you're watching on X, John, well, looks like you're watching on YouTube. So wait till the video is over, then actually comment beneath and then CMBPS. And then that way I remember that you're the one asking for it. But yeah, have a great Saturday, guys. I got to go watch the kids. The wife needs some R&R, rest and recovery. I appreciate you all being here. I still got his comment up here. Appreciate you all being here. I hope this was insightful. I hope this helped. Remember, this is just the first episode. This is just the first time. We're going to be doing this bi-weekly. Every other week, we're going to be doing the fundamentals. We're going to be doing due diligence weekly. We're going to be looking into new companies. We're going to be looking into our current companies after earnings, running the numbers. I'll be answering your guys' questions. I'll be helping teach you all how to invest, how to stock pick, and how to find 10x opportunities. I appreciate you guys all. If you haven't already, smash the like button, subscribe, share this to somebody who wants to learn about investing or wants to have a strategy. But have a great weekend, everybody. And I will catch you guys next week for Technical Analysis Weekly, back to the charts. And yeah, I'll catch you in the week ahead, guys. Have a great and awesome weekend. Love you all.